If you've been saving for retirement, you're in the crosshairs of the retirement tax time bomb. Today, we're going to talk about what that is and how you can protect yourself. Hi, I'm Dave Lopez.
And I'm Chase Lopez, and we're investment advisor representatives with ILG Financial. This is another episode of Retire Your Way with ILG Financial, where we talk all things retirement. All right, so before we get started, Dave, just want to let everyone know, go ahead and hit the like and subscribe button down below. And also today, we're going to be talking about a few different concepts and different topics. We also have the podcast as well. We do other videos on this channel as well, but we have our podcast, Retire Your Way with ILG Financial, where we go into more depth on each of these different topics. So go ahead and check us out on wherever you get your podcasts.
Mm-hmm.
So before we get, let's kind of jump right in, Dave. The retirement tax time bomb. That's certainly an eerie sounding term. What are you talking about when we talk about the time bomb there?
Yeah, so we're going to go 10,000 foot view. That's okay, Chase. So imagine you're saving for retirement. I hope everybody watching this is saving for retirement. And for most of you, you already know there's a million ways to save, different types of accounts.
Right.
You can save in a regular account. You can save in an IRA or a 401k. That's called a tax-deferred account.
Yep.
And there's tax-free accounts. An example would be a Roth IRA. Would be a tax-free account. They're taxed differently. You can invest in the same stuff. They're just taxed differently.
Right.
The tax time bomb applies to the tax-deferred accounts, the middle one we talked about, your 401ks, your 457s. If you're a government employee, it's called a TSP.
Yep.
If you're working for the hospital, 457.
403B. Yeah.
403Bs, right? They're called different things, but they're all IRA.
Traditional retirement.
Traditional IRA. They're traditional retirement accounts. You got a tax deduction when the money went in, and that everybody loves that, right? Then the money grows tax deferred for your lifetime, and when it comes out, it's taxed at your ordinary income rate. Now, here's why that's so important. For those of you who don't know, again, check into our podcast or even reach out to us, and we can walk you through. But in the United States, the tax code is what's called a progressive tax code. And the best way I can explain that, remember back in junior high school, Chase, when you did biology and you had those graduated cylinders?
Oh, yeah.
Right? And you poured liquid in and it would measure the milliliters.
Yep.
So imagine you've got a graduated cylinder, and as you make money, taxable money, it goes into that cylinder and fills up. The first part of the money you earn is taxed at 0%. That's either your standard deduction or if you can itemize deductions. Okay. If you're a government, if you're in the military, you might have a disability check that's tax-free, right? So that would be all in the 0%. But then the next dollar you make, we filled up the zero part of that cylinder, is taxed currently at 10%. And for a married couple, that's how much, Chase? 23
or 24,000.
Yeah, about 23,000, about half that if you're filing single.
Yep.
And then you fill that up.
Yep.
Then the next dollar is at 12 and so on. 12, and then that goes to 22, 24, 32, 35, and so on. So as you make more,
you pay more in
you're
taxes.
paying a bigger percentage of taxes. Now, here's why that is a problem in retirement with the tax bomb. You're saving money in these tax-deferred buckets. They're growing and growing. If you're lucky, you're doing a great job, you're never paying any tax. Right? The whole theory behind that would be that you would retire in a lower tax bracket. And I will tell you, when you can read it all over the internet and any articles that you read, but more and more people are starting to come out and publicly acknowledge that it is very likely that you will not retire in a lower tax bracket. You have a combination of you losing many of the deductions that you have. But also that we're expecting tax rates to go up, and you've got to make a bet. But the data is overwhelming. We're at $34 trillion in debt. No one seems to have an answer. It might surprise you to know we're at historically low tax rates now. So if taxes go up later, you could very likely be at a higher tax bracket in retirement than when you took the deduction and saved the money.
Yeah, so that tax deferred bucket, that can be one of the worst buckets to be in that rising tax environment.
Well, it is. Speaking financial wise as a tax person, other than the initial deduction you get, that is the worst bucket to hold money in because it's all taxed, and it's all taxed in that graduated cylinder at your ordinary tax rate. There's different kinds of taxes that you're taxed, long-term capital gains and ordinary income tax are the two major ones. But the ordinary income tax rate is going to always be the highest tax rate for you, the worst possible scenario. Is that a good way to say it?
Yep.
And so you ideally don't want your money all in a bucket that's going to be taxed at the worst possible rate. So other than the deduction, it's not a good bucket to be in. So the problem is...
Oh, go ahead. Sorry.
That's all right. The problem is if we think taxes are going up, every time the tax goes up, it's almost like the government reaches in and took a withdrawal out of your account.
Right. And some people will say the solution, Dave, is, well, I will never take the money out. And the reality is the government doesn't allow that. You have to start taking money out of that account. The Secure Act 2.0 was passed in 2023. Depending on when you were born, you have to start taking money out of that account starting at age 73, for some at 74, for some at 75. But you have to start taking money out of that account. You have to take money out of that account every single year. And why does the government require you to take the money out? Because
they want their money.
They want the taxes, right? You defer the taxes, and they want, and quite frankly, need those tax dollars. So the money has to come out at some point, right? We won't get too far down this rabbit hole, but when that money comes out for your required minimum distributions, it comes out, it's taxed. You have to put it in another account, right? If you're not going to spend it, reinvest that money. And now that money has to be in a tax, what we call tax as you go bucket. So now not only did you pay the taxes when the money came out, but now you're going to have to pay the taxes on all of those earnings in the future, which just starts to compound, right, over time. So
it's a worst case scenario.
Right. So, there is no option to not take the money out, right? You're going to have to settle up on this tax bill at some point. So what do we do, right?
Let me give you one more thing that makes it worse. Let's say the R&D started about 4%, roughly. Yeah. And then they go up as you get older. Because the government, ideally, if they had their way, they'd have it all out by the time you died. Right. They want the taxes. Right. You did a great job of explaining that. But that's not what happens. If you're just having really relatively normal returns, 5 to 6%, it's likely that between 75 and 90, when you die, you took all these RMDs, paid all of these taxes, and you may still have close to the amount in the account when you die that you had when you were 75. And you're like, that's super. I want it to go to my kids. They're going to inherit it. Now is when the tax bomb really explodes, because now those kids have to pay tax on that entire bucket. They used to be able to defer it over their lifetime. It was called an inherited IRA or a beneficial IRA. They would take a little out each year, but over, say, 30 or 40 years. Pretty good deal. Well, the government changed that with the Secure Act 2.0 changed that? Yeah. And they said now you could have to defer it over 10 years. You can only defer it, right? So if your kid inherits this, they've got to get this money out over a 10-year window instead of maybe a 40-year window. Now, that exacerbates the tax. Even without raising the tax rate, cramming more money, if your kid's having to withdraw that money over 10 years instead of 40 years, means their taxes are going to go through the roof, because remember the graduated cylinder? It'll make more money recorded as income, meaning it'll be in higher tax brackets. It's just a double whammy. And if they change that law again, you have to guess, they've already changed it once, what's going to cause them to change it down the road before you die to say the kids have to take it out in 5 years or 2 years?
Well, and quite frankly, it's not a political statement. I mean, it's in their best interest to whittle that down, right? Because the government needs the money, right? It's not nefarious, or they actually need.
So even if they don't change it, just having to take it out over 10 years, remember, your kids with luck are successful at what they do. So their incomes are using up those lower 4 or 5 tax brackets. It means any extra money that they have to report, your IRA, your 401k, will be reported in these higher brackets. And what do we hear? All politicians on both sides say they're open to raising the tax rate on the upper brackets, the wealthy. But imagine a scenario where your children are in the upper tax brackets just one time in their life, and it's the period where they're paying off the tax on your IRA. So you've saved, invested, done without, and you're so proud that you've saved $1 million that you pass on to your kids. But because of how this tax code is diabolically structured and rammed into how they're taxed, and you raise taxes, it's not inconceivable that they could take 30 to 50% tax on the money you spent a lifetime saving.
Right.
That's the problem.
Right.
Now, if that doesn't sound like a time bomb to you, I said it wrong. So how do we fix it?
Right. So there are things that you can do proactively to insulate yourself as much as you can from this issue, right? So what you can do is, and I want to, before we kind of dive into it, remember, we're talking 10,000 foot view here. This is not advice for any one specific person. Make sure you get with your financial, if you think this is a problem, right? If you think you have this tax bomb issue, make sure you get with your financial professional and tell them that it's a problem, and they will help you implement a solution for it. One thing you can do, though, is acknowledge that, hey, taxes are going to go up in the future, right? You have to make that bet, but you can acknowledge that and say, okay, well, now what I'm going to do is I'm going to pay the taxes today, move that money into a bucket where it's never taxed again. So a Roth conversion is what it's called, right? You pay the taxes today, it goes into the Roth IRA, and then it continues to grow tax-free for the rest of your life. And then also, to your point, Dave, it goes to your heirs tax-free. So one other point there is that the Roth IRAs don't have required minimum distribution. So you can leave that money in there forever if you want to. So, really what you're doing there is you're getting ahead of this tax bomb.
Yeah, you're just settling up with the government at today's historically low tax rates.
Right.
But the other thing that you said it very well, I want to make sure it doesn't escape the audience, is it's a double benefit.
Right.
Remember what we said when your RMDs came out?
Right.
You pay the tax, and now they have to go in a tax-as-you-go bucket where it's taxed every year on the interest or dividends.
Right.
If you do a conversion, it doesn't. It can go into a tax-free bucket. Now that same money can grow over your lifetime, but it's never taxed. So you save a whole tax, future tax on that money.
And one thing to note is those RMDs, once you get to that age, once you have to take that money out, your required minimum distribution, whatever that amount is, that cannot go into a Roth at that point. Right. So you definitely want to get ahead of this. You definitely want to plan in advance, and get with your financial professional to build out that strategy for yourself.
Yeah, because it's something that has to be done year after year. So it's not a one size fits all. With our clients, every year we're reviewing the current situation for that year. What's eligible, what's the best way to do the Roth conversion. There's a lot of moving pieces. So that's the first thing, Roth conversions you can do.
Yep.
Another one would be distribution strategies, right? Order of distributions. So a lot of folks have never even heard of that term. But that just means if you've got a bunch of buckets, a tax-as-you-go bucket, a tax-deferred bucket, and a tax-free bucket.
Yep.
Don't just take, if you needed $10,000, don't just take a third of it from each bucket. What's the best way to do it? Well, if you think taxes are going up, maybe in the beginning, we're taking it all out of the tax deferred bucket, because we're settling up where taxes are low, and we're saving the other two that are, both of them to different degrees are better than the tax deferred, right? We'll save those to use for money later. We also call that order of withdrawals.
Right. And it goes back to your fantastic graduated cylinder analogy there, right? Where if your financial professional should be doing this for you. But when you get with your financial professional, what you want to do is utilize the bottom of that graduated cylinder, right? And there's different ways that you can do that. It's not just, hey, I'm going to take out $10,000 from, to your point, this bucket because I'm just looking at it and that's the one. There's no randomness to it. There is a system that you can put into place that will maximize the amount of money into your pocket and minimize the amount of taxes that you're going to be paying.
I will tell you, because we've done this before, if you're taking your stuff with the exact same investments, no change in investments, just picking different ways to withdraw the money, the end result to you can be thousands of dollars over your lifetime without changing any investments. No change at all, just the order of the withdrawals that you take. So that's a biggie. And the third one, which is part of that same strategy, but just to give you, it's a nice bookend to it. A lot of folks, they'll retire and then turn on Social Security. Because I need some income. Well, again, get with your financial professional, but it may be beneficial to let your Social Security grow. Now, you still need money. So maybe we're taking some of the money out of the tax deferred buckets at today's lower taxes. So we solve that problem. And we're getting compensated because your Social Security grows. And then once you've moved some money, used it, we now at 70 say we can turn Social Security on, and it's at a nice bigger check,
Right.
and we've moved some money to tax deferred,
Right.
or tax free.
Yeah. So there's a unique plan for everyone, right? Everyone's situation is a little bit different. Their income is different. The amount they have saved is different. But the big picture takeaway is this tax time bomb that we spent some time talking about, it can be proactively taken care of, for lack of a better term.
And
right?
I will say a big takeaway is get with someone.
Yes. Yes.
Give us a call, get with another financial advisor or an account, because there's too many moving parts.
Absolutely.
Unless you want to really get the time to educate yourself on all that. There's so many moving pieces.
Right.
You want someone who's looking at all of them that can walk you through, and you and them together collaboratively can come up to the best fit for you. But there's things you can do, but time's wasting.
Yeah.
Because every time taxes tick up, you miss an opportunity, a lost opportunity, because you could argue that those taxes will never be that low again.
Yep.